This next section on evaluating the change in financial leverage is probably the most challenging of the 4 sections in our formal ROE decomposition. Again, first thing we want to do is restate the concept or ideas from our opening paragraph, that LA Gear has reduced its financial leverage. Its asset to equity ratio decreased from 2.97 to 1.77, but it's still above the industry average, and that generally this would signal a decrease in financial risk. But LA Gear, we'll find later on, and we'll talk about here in this section, is facing some liquidity problems, and this is largely due to its rapid growth. If we sell more, we're going to need more inventory. If we sell more, we're going to have higher accounts receivable. And so we saw with sales more than tripling over the last 3 years, they've had to invest heavily in additional receivables and inventory, as we saw on our cash flow statement. Let's go ahead and begin with our template. The first questions I like to ask are, is this company profitable? And our answer to that is yes. And then also, because profits, of course, will increase equity and thereby decrease our financial leverage. But I'd also like to know, does the company pay dividends? Because if we're paying dividends, that's money we don't have to reinvest in our business. And for LA Gear, the answer to does it pay dividends is no. We can see that by looking on our cash flow statement, no dividends there. And we can confirm that if we look at our balance sheet and look at the change in retained earnings between the years, or calculate the retention ratio, which is how much of our net income we kept in the business. So our retention ratio, we can take the difference in retained earnings between the 2 years, 83 minus 28. So retained earnings went up by $55,000, and we can divide that by the amount of net income for year 2, which was $55,000, and we can see that we have a retention ratio of 100% in both year 1 and year 2. So all else being equal, profitable company, no dividends, that will increase equity, and everything else being equal, increases in equity mean we are using less debt. Next thing I like to look at is go to our cash flow statement, and I'd like to know what's going on with cash flows. And also, are cash flows needs sufficient, or operating cash flows sufficient to meet our investing needs? So let's look at our cash flow statement. What were our most significant cash flows? Our most significant cash flows are really accounts receivable, inventory, and net income. And again, net income doesn't represent cash coming in, but it's the first component in our cash flow statement. Next question I will ask then is, are cash flows, operating cash flows, sufficient to meet investing needs? And the answer to that is an obvious no. We had negative operating cash flows, yet at the same time, we were purchasing new plant and equipment. So we aren't generating enough cash from operations to cover our investing needs. So then the question becomes, if not, where's the money coming from? And we can see from our cash flow statement that over the 2-year period, in year 2, we repaid our line of credit by $23,000, but in year 3, we increased our line of credit by $56,000. So over this 2-year period, we've increased our line of credit by about $23,000, and we've issued roughly $74,000 or $75,000 in new common stock. So the sources are common stock, and we have our short-term debt, which is our line of credit. And overall, were our financing cash flows positive or negative? They were definitely positive, which isn't surprising given we had negative operating cash flows, negative investing cash flows. So the cash has to come from somewhere, and it's coming from our financing activity. So if we want to talk about why did our equity or financial leverage decrease, let's talk in terms of these items. And here you can see I talk about LA Gear's operating cash flows were a negative $83 million over the past 2 years due to its rapid sales growth and related buildup of inventories and receivables. Again, we saw that on our cash flow statement. Receivables went up by $106,000 over the 2-year period. Inventory went up by close to $91,000 or $92,000 over that 2-year period. So we've identified that operating cash flows were negative, and yet we had a big operating deficit to build up inventories and receivables. How did we fund that? We funded that with additional borrowings on our line of credit and through issuing common stock. So in addition, we did have an increase in debt, but this was more than offset by what? The $75 million in additional common stock and the increase in retained earnings over the 2 years in the amount of, again, we can look at our cash flow statement, retained earnings went up by, because we didn't pay anything dividends, retained earnings went up by $86,000. So $86,000 increase in retained earnings, an additional $75,000 in new common stock. Those are the reasons that financial leverage decreased. In this section, I also typically want to talk about things like our times interest earned ratio, or maybe our cash conversion cycle. How are we doing at generating enough cash to meet our ongoing obligations? And our times interest earned ratio, if you recall, decreased from $10 in operating profit for every dollar in interest expense down to $3. And we are certainly much worse than the industry average. So that's a real source of concern. And again, we identified the reasons for that on our income statement. There were 2 primary reasons. One, our taxable income or operating profit has gone up just a little bit, has gone down or up just a little bit from $41,000 to $69,000, but not nearly enough to keep pace with our nearly 4 times higher interest expense. So our operating profit margins have gone down, again from 18% to 7%, and our interest expense has gone up. Both of those are contributing to our lower times interest earned ratio. Next thing we're going to take a look at is our cash flow conversion cycle. And again, that was a measure of how long does it take between cash going out the door to buy inventory and then cash coming in from collecting receivables. So we took our inventory period, cash going out, but we don't pay for it right away, so we subtracted off our payable period. And then, of course, we don't have cash coming in until we collect from our customers. So the 80 and the 188 would add up to 268. We subtract the payable period to get our cash conversion cycle. And we are doing it better at cycling cash through the company. It's shortened from 240 days to 150 days. But that's still much slower than the industry average. So our cash conversion cycle has decreased, which is a good thing. That's better, but we are still worse than the industry average. Overall assessment of liquidity, I would say it's improving. Again, our asset to equity ratio got smaller, but it's still higher than the industry average. And we're going to find we really do have some liquidity concerns.